to another component of sales, which is the sales of inventory. So let's assume that we had a sales of inventory which was costing us 2,200, and the actual sales were 4,000, and all the sales was made on credit. So let's see what accounts were affected. So let's put this transaction as 11. Let's make it a bit bigger. So as it was made on credit, we have accounts receivable increased by 4,000, and there was also a decrease in inventory by the amount of 2,200. We input the sales revenue in Jacob's capital, and let's label it as a sales revenue. So in total it was 4,000 increase, and also we recognize the inventory, the cost of inventory, as a cost of goods sold, which is actually equals to the inventory, to the worth of inventory that we have sold. So you may see that we again have a balance in our balance sheet, transactions, and we have recognized the sales of our inventory. As you may see, there's a difference of 1,800, which actually compromises the gross profit of our business. Now let's move on with the concept of adjustments. So adjustments are events that do not normally occur according to the source documents, and that's why we all the time when there's an end of months, end of quarter, end of year, the accountants look for this kind of transactions that need to be adjusted because of the time pass. So as you may recall from one of the first transaction on the bank loan, we have received the bank loan at the 8% annual rate. Even though we are not required to pay this interest rate right now, meaning in the beginning of the 2009, still we recognize this expense each month. So let's see how much interest expense will recognize. So let's input this transaction as number 12. So we have interest payable, which is our liability at the end of this year, in the beginning of the next year. So interest payable, but the amount actually will be not the full amount that we have borrowed, but only the fraction of it according to 1 month, so only 1/12. So the total amount that we have borrowed, if you recall, is 20,000 multiplied by the interest rate that we have, 8%, and also multiplied by 1 divided by 12, which is actually taking the January portion for this interest payable. So it's approximately, let's decrease the decimal places, so it's approximately 133. And also we recognize it in Jacob's capital as an interest expense, which is also 133. So this was it for the portion of interest for January. Another issue on a rent expense. As you may recall from our previous transactions, let's see, it was 12,000 for a whole year, and it was prepaid rent. Now we need to adjust it each month so that at the end of the year we have a total of 12,000 expense, and proportionately we have the prepaid rent to become 0. So let's input this transaction as number 13. So at the end of January we have prepaid rent decrease by the 1/12 portion of 12,000, which actually makes 1,000, and it's also a negative number because it's a decrease. And also we have a rent expense in a owner's equity, which also a decrease by 1,000. Again, we have a balance. Now let's update, before moving on to other transactions, let's update our balance sheet with the new transactions that we have entered. So let's add the balance sheet, the 6th transaction. So in here, let's add some rows in here. So insert, and then we press F4 as a repetition. So as you may see, we have added quite a lot of rows in here. So 6th transaction, an increase of cash by 200, an increase of accounts receivable of 400, and increase in Jacob's capital. So cash increase 200. So actually we add another point in here. So let's add this accounts receivable, which is actually 400, and also Jacob's capital increase by 600. 7th transaction is about the prepayment by the customer. So let's skip this for now. 7th example was for this specific case only, so we just for now we ignore it, and let's go for the 8th one. So 8th one was salary wages for the salespeople. So we have decrease in cash and owner's capital by 700. So cash decrease 700, and also owner's equity. Alright,